There are 7 key steps we need to consider in order to calculate the NPV and conduct our NPV analysis. Firstly, the relevant upfront costs to undertake the project or investment should be identified. These include costs associated with lost revenues. However, they do not include any sunk costs that have already been incurred. Let's consider the purchase of a new factory machine to replace 2 existing machines on the production line. The initial investment will be $590,000, which is the cost to purchase and install the new machine ready for use and to remove the 2 machines that it is replacing. Secondly, the future cash inflows and cash outflows of the project or investment should be forecasted. This includes any savings in cash outflows as well as any lost cash inflows. In our example, the new machine is expected to yield efficiency savings of $120,000 in year 1. Then, once all of the kinks have been ironed out, it is expected to yield efficiency savings of $200,000 each year for 4 more years. These savings in cash outflows are treated as positive cash flows in our NPV analysis. We need to apply these cash flows over the life of the project, and this machine has a useful life of 5 years. Thirdly, any residual value of the project or investment should be estimated. If, at the end of its useful life, the asset or investment can be sold for positive cash flows, then we have a positive residual value. But we may also incur costs to decommission or dispose of the asset, and these will be reflected as a negative residual value in the final year of the analysis. In our example, we have a machine that will be worthless at the end of its useful life and will actually cost us $20,000 in year 5 to decommission and dispose of it. Once we have identified all our cash inflows and cash outflows, we sum these together for each year of the project to obtain the net cash flows for each year. So, now that we have worked out all of our cash flows, we need to determine the discount factor to apply for each year so that we can calculate the present value of those future cash flows. To do this, we need to know the discount rate to apply, remembering that this will usually be the required rate of return or weighted average cost of capital. In our example, the company's WACC is 10%, so we use this and plug it into our discount factor formula to calculate the discount factor for each year of the project. And here we can see that the discount factor for year 0 is actually 1, as it is already in today's dollars. Then, to determine the present value of each year's cash flows, we simply multiply the relevant cash flow by the applicable discount rate. And finally, we add all of these present values together with the initial investment, and we now have our net present value. In this case, our NPV is positive and it looks like a good project to pursue.